get started here. Just a quick introduction. If anybody doesn't know who Foothills Forage and Grazing Association is, my name is Sonia Bloom. I'm the environmental coordinator. And FFGA, as we quickly describe ourselves as, is a nonprofit producer-driven group. We're made up of a board of 11 volunteer forage and livestock producers across our region, which goes from Olds down to Waterton, and then we're along the eastern, the Porcupine Hills, the eastern range there, all the way out to kind of Newell area. So pretty big area, about 12 counties that we cover across. We do different events. We have a newsletter, social channels. We do on-farm field tours, demonstration projects, environmental farm plans, lots of information on producer funding opportunities, and I can help advise programs that might fit for your farm. And we're actually very excited because we're starting our summer field tour season. So some of our upcoming events include producer field days at the Matthias Ranch near Gem. We have a 2-day summer grazing tour near Swalwell at Ribbon Creek Ranch. So that's Jerry Berg's place. That's July 29th and 30th, and we'll have Jim Bauer and Daryl Chubb speaking at that one, as well as Ben Campbell. Pretty excited for that event. And then we're doing a quick morning tour on small ruminant experience. So we will be near Strathmore with Graydon Gardner. We'll be able to see how he's using his sheep in rotational grazing systems and some of the stuff that he's doing, including brush control using grazing. That's pretty cool. And then just fresh off the press, we are excited to go to Uruguay for next year's Ag and Sightseeing Tour. So sightseeing tour is something Foothills has done since, I believe, 2010. We've visited many different places, and this year we're going to Uruguay. So if you'd like more details, then make sure you guys are checking our website. So tonight we're going to be joined by Ryan Copithorne with Cows in Control, and he's going to sorry, I'm just admitting everybody here. He's going to take it from here and give us an update on markets and talk about some strategies and give us about a 45-minute presentation. And then we will have time for questions. So if you do have questions, if it's a burning question, then Ryan said we can take it at that time. But if you can, hold on until the end and we'll have a question and answer section. So Ryan, without further ado, you can take it from here.
Okay, thank you. There, is that up there?
Yeah, you're good to go, Ryan.
Okay, good. Well, thanks for having me. It's a nice rainy evening here, which I'm very thankful for. I think we've had 2 inches of rain here tonight, so I'm very pleased to have it. I hope everybody else is getting some of this rain too. I know it's sure spotty around the province. Seen places that are pretty bad, and then I've seen other places that are really good. So it kind of depends where you are, but we're glad to have the rain here tonight. So tonight I wanted to just do a presentation. Generally, I'll do a presentation on sort of what the market's doing and risk management in general and that type of thing. Um, Tonight I'm kind of zoning in maybe a little bit more with this presentation on the fact that we're in such a big bull market for this cattle market. And we've been doing this for 5 years with these prices going up for 5 years, that it's time to start thinking about, kind of what's on the other side of this bull market. What if this thing starts to correct a little bit? And what would that look like? So I might, hopefully I'm not going to depress you with talking about like down markets or sideways markets, but I really want to just kind of give you sort of targets of what this thing could do or give you some expectations going forward. So what does a market top look like? Well, it's when you see cattle are kind of standing out by themselves and they're only things up in the market. We've got grains that are on the floor. We've got pork and chicken that haven't caught up to cattle. When you start finding out that the cattle are the only thing that are high, then you have to start looking around, wondering, does it deserve to be up this high? And one example would be the cattle hog ratio. Like these cattle have gone up just uninterrupted for the last 5 years, and yet hog prices haven't contributed. And the same thing with the with South American and global beef prices. They just, they're half of what US beef prices are right now. So you wonder, can we justify this? Can we keep this premium going and for how long? And obviously, I mean, the beef price in the retail has just been astronomical, huge, huge prices at retail. So we're very grateful for the consumers that have been keeping this thing going and paying these big dollars for steaks. But at some point, we have to start asking ourselves about substitution. When does substitution come into this cattle system? One of the bigger fears I have is that beef gets, kind of like lobster, where people only eat it a few times a year as sort of a luxury item. We don't want that to happen. That's why we kind of actually have to sort of welcome corrections that come in the cattle market and times of when these prices can pull back a little bit so beef gets back on the menu. Because there's no question beef prices are going higher, and they have been going higher, but the actual beef consumed, I think, is starting to drop. So we have to make sure that beef stays on the plate. But therefore, I mean, looking at our prices, it's just been a phenomenal run. These are calf prices and going for the last 20 years. And you can see that we've just blown the last cattle cycle rate out of the water. I mean, we're looking at $6 calves this fall, whereas the top of the cycle last time we only got into the $3 range. So this has been an extraordinary cycle compared to other cycles from the past. I mean, I'm showing the two big cattle waves in the 1970s and then our last cattle cycle in 2013 to 2015. And you can see that we're just sort of tracking right along with those in terms of magnitude of how fast it's growing and how big it is. And those other cycles started to roll around this time. I'm not sure if this one's ready to roll or not, but it's definitely kept up with those prior bull markets. So is a 10-year cattle cycle still relevant? Well, this to me is the one that we need to kind of look at because it's like the 10-year cattle cycle. Everybody knows this is a very cyclical business, and generally, it overall does kind of run in 5-year waves where it's 5 years up, 5 years down, and it's not always a perfect five, and sometimes it's 5 years sideways, or it doesn't have to be up or down. It can be sideways, but for the most part, since 2020, we've been running for 5 years straight with higher prices. We just have to expect at some point the cyclical nature of this business is going to cause it to roll over at some point. When you look at what's the magnitude or what do these rollovers look like generally when it happens? Well, this is a chart going back to the 70s, and you can see the sort of the size of the pullback every time these cycles roll over. It can be anywhere from 25 to 70% pullbacks. I mean, the one we had during the BSE era in 2003, that was a 70% pullback here in Canada, when in the US they only dropped 25%. The last one we had in 2015, that was a nasty, nasty drop. Like that thing dropped 55% and it did it all within 2 years. So I don't think we're going to see a repeat of that. I hope we don't see a repeat of that. I really think it's going to be more like that one on the far left of the graph where in 1979, when it peaked, then it just kind of slowly gave back kind of sideways and slowly giving back prices over the next while until it was ready to take off again. I probably think that's the most likely with how short of cattle we are. But at some point, we do have to expect a roll. Here's the here's the last cattle cycle. So if I took from 2010 to 2020 as the blue, and you can see that peak in 2015. Well, I've overlaid today's cattle cycle on top of that, and you can see that it kind of overlaps right now. It's about the same magnitude as the last one, but you can see in 2015 that on that blue portion where all of a sudden it just fell apart. When that market ended, it just dropped like a stone, and it gave back 50 to 60% of its prior gains. I don't think we'll see anything that drastic this time, but those are things that you can look at as if it was to do something like that, it'll give you an idea of what those prices would look like. So on the right-hand side of the graph, I have today's 8 weight steer prices. And so right now you can see that orange line has got up to about 4.25 for an 850 pound steer. If we were to give back like the last cycle did in 15 and 16, we would see 8 weights under $3. Now, as I said, I don't think it's going to be that severe this time, so I think it's probably going to be somewhere a little less than that, maybe 350. But just to give you a historical sort of reference of what those kind of drops look like in today's cattle prices. So you say, how could this market go down? Like we're so short of cows. There's no way that prices can go down because we just don't have the cattle to justify lower prices. And perhaps, there's some truth to that, but at the end of the day, when you look at these beef cow numbers, which is the blue on this chart, yeah, they're down 35%, but our feedlot numbers are still higher than they were in 2005. And in 2005, we had 5.5 million cows. Today, we have 3.5 million, but we have more cattle in feedlots. So at the end of the day, we're not short of cattle in feedlots, we're short of cows. So how does that translate? The same thing we're seeing in the US. I mean, their cattle herd inventory is down to levels they haven't seen since the 50s when Elvis was alive. But beef production is, traipsing along right at the tops here. So we're seeing the same sort of thing. This is innovation. This is productivity. This is, it's genetics. It's veterinary things. It's, beta agonists, hormones, all the things that we're doing to produce more beef from fewer and fewer cattle. If you look in reality, though, in the US, the cattle on feed numbers in the last 5 years haven't moved. They've been stuck between 11 and 12 million head for the last 5 years. And yet our cattle prices have tripled. So it says to me like this isn't a cow issue. This isn't a supply issue that's pulling these cattle prices higher. This is something else. This is something on the demand side because we're not short of cattle in feedlots for sure. So here in Canada, just to give you a visual, in 2000 we had 5.5 million cows. Today we got 3.4 million cows. So obviously, a couple million cows less. But when you start factoring in these other factors, you can see how we can produce the same amount of beef with less cows. If you look at the fact that our carcass weights are so much bigger now, the increase in carcass weights since in the last 20 years is the equivalent of adding 16% to our cow numbers. And when you start adding in beef on dairy, there's a 500,000 beef on dairy that have entered the system in Canada. In the US, that beef on dairy number is more like 3.5 million. So that's another 15% added on to the volume of beef produced or, equivalent cow herd size, I guess you could say. And then there's this whole production efficiencies, and I put 10%, but I honestly I don't know what that number is, but it's like that's all your genetic improvements, more pounds weaned per cow, performance in the feedlots, all that stuff that we do we can actually produce the same amount of beef with less and less cows. And that's what's going on today. We've got the same amount of beef as we did 20 years ago, but our prices are 50% higher. So that really is a retail demand story. And you can see that the beef retail prices just keeps going up, breaking new records. We're still making new highs in terms of this retail beef price. I think we're starting to see volumes drop off a bit, but we're definitely seeing people still paying up for the beef. And so what's driving that? Well, if you look at the steepness of that retail chart and then you look at the steepness of this chart, you can kind of get a feeling for what's going on. I mean, there's been so much money printed, especially since the great financial crisis in 2008, that it's just driven the stock market to all-time highs. So it's paled the dot-com bubble and the housing bubble from the early 2000s. Those are just blips on the radar compared to where the stock market is today. Now we're dealing with this wild, crazy president and these tariffs, and we don't know how long, whether that's bullish or bearish. So far, the market's kind of taken it in stride, but this is really what's been pushing these cattle prices and retail demand higher is people got wealth. They're going out for steaks. Another thing that's pushing these prices higher is these well, Joe Biden, when he was president, put in something called the Inflation Reduction Act. And the Inflation Reduction Act thought it would be non-inflationary if they threw $1 billion at the packing industry. Well, that what happened was immediately we had six new packers come on stream, 6,900 head per day, and all those new plants in the last year and a half that have come on are now, demanding beef supply that's ever shrinking. So there's been a lot of new plant demand for these fed cattle and amidst a small supply of cattle. So that's though it was designed to reduce inflation, I would say it's very inflationary what was done there. And so we went from a situation where we had more cattle than we had packing space. As in 2021, we had 9% more cattle than we had space for. Now these plants are operating less than 80% capacity. So where they were working 5, 6 days a week, now they're working 3 days a week, 4 days a week, very light schedules. And they just keep cranking up the margins on, they're trying to crank up the margins on these cattle. The cutout is what the packer sells to the retailer for. So that's the wholesale beef price. And so they've jacked these cutout prices up as high as they were during COVID when the packing plants were closed. And yet they're still losing money. And that's the reason for that is that cattle prices have risen so fast that the packers can't keep up. They can't charge enough out the back door to keep up with what the cattle prices have done. So packers are starting to lose money. And that's something to be a little bit wary of in these cattle cycles, because when these packers start losing money, or if they go dark, that's when these cycles often have a tendency of turning. But for now, they've just cranked these cutout prices to super high levels, and the retail seems to be absorbing it for now. This is what our packing industry looks like in Canada. There's about 10 to 15% of our supply goes to the US right now. This is one where you really want to keep your eye on Trump and what goes on with all this trade talk because number one, we have this sort of tariff war going on right now. Number two, you have country of origin labeling coming in January. And number three, we have the renegotiation of the free trade agreement between the US and Canada coming up this next year. And so what happens to that last bar that those US, cattle going to US plants is really going to hinge on that. So there's two scenarios. One is that nothing happens and the border stays open and cattle trade freely. Well, then I would expect more and more cattle to go to the US because they need those cattle so bad down there. So we would start seeing more and more cattle head south, which might pull away from some of our plants up here where we might actually lose a plant or two. On the contrary, if Trump gets really tough and we get into a trade war and things get bad, then Canada has to find a way to absorb all that beef that's normally going south. So it's I don't know what the outcome's going to be, but that's just something to watch and keep your eye on. Carcass weights have just been going up steady. I mean, this has been a trend that you could just set your watch to for the last 50 years. But every 10 years, it's like getting rid of 10% of our cow herd. As long as we keep making these cattle big, we don't need as many cows. And so we're seeing the cow herd slowly being replaced by grain and beta agonists and hormones and those type of things. But I'm not sure how much further this can go. We're almost at 1,000 pound average carcass weights now. And it's getting to the point where I think this trend has to level off at some point, but so far it hasn't. We're looking at probably a record crop of corn coming out of the US this year. Feeding margins are not looking good going forward for feedlots, and grain is cheap. I think it's going to be extremely cheap for the next year. So would we or could we see like record carcass weight averages? This is something to keep an eye on. I think by November, I think we're going to see carcass weight averages we didn't realize were possible, but we'll see. We'll see how it plays out. So far, they got a good corn crop coming on down there, though. when you make these animals bigger, what it does is it just slows down the flow in these feedlots. So as we stand these cattle in feed pens and feed them longer and longer, it just slows that supply down. And that's why we're seeing these feedlots so full of cattle. It's kind of a it's kind of an illusion in the sense that we're hiding the fact that we're short of cattle by just stacking up all this beef in these feedlots. At the same time, our imports were up 20% this year compared to last year. So we're bringing in a lot of beef to make up for the lower slaughter numbers that we have now. And we actually have 9% more cattle on feed over 150 days in the US than we did last year. So there's a lot of fat cattle standing in feedlots right now. Our imports are up 20%. I'm thinking that we've got pretty ample supply coming up in the next couple quarters. And yet these cattle futures just keep climbing. So it'll be interesting to see how much strength is left in this market. But I do think there could be ample supply here coming forward. And so we just have to ask the question, when does this thing turn? And nobody seems to know, including myself. So all we do is make educated guesses based on historical patterns and historical tendencies. And this is why we manage price risk. So for you people that are grassing cattle, for example, if you're taking a yearling steer to 950 pounds by September, you're going to be sinking about 3,800 bucks into that steer. That's a huge amount of dollars that's invested in that animal to get it to September. And then the profit margins, that depends on whether you raised it or bought it, but like the profit margins this year were actually quite slim. So let's say you have a $150 profit margin, which would be probably generous on this year on a $3,800 animal. And a lot of times when people are talking about livestock price insurance, they say, well, I don't like livestock price insurance because I can't lock in my profits. And I like to show this chart to people because it's like, you're right. You can't lock in your profits. It's the LPI floor price is below your profit level. But what is it that you're really trying to protect here? Is it that skinny little $150 profit margin, or is it the $3,800 that you've sunk into that steer? And so this is just a visual for you to kind of get your mind around like why, hedging isn't about profit necessarily, it's about preserving your assets. And so this is, these what if scenarios. What if we get tariffs? What if we get a 30% correction? What if we just go back to where prices were a few years ago? Well, those are $1,000 a head drops in prices. And you can see that yellow line is where the LPI is today. So, you would sort of prevent yourself from one of those huge drops happening just by having some sort of coverage, whether it's insurance or some other method. When in the cattle business, this is something that I always focus on when I was ranching was how do we make more production? How do we make more dollars per cow? That type of thing. More weaning weight, more calves weaned. Make them look pretty. Do whatever you can to add value to these cattle. And there's 400 bucks a calf in this example. But if you're ignoring the marketplace, a simple 25% market move can come along and take all that hard work away from you. And this is really this is where I got into the business and why I got into the business because I got tired of that happening. So you have to keep your one eye on the marketplace at all time while also managing your doing the management side of things. When Warren Buffett was asked, how do you make money? His response was never lose money. It's not about how much you make in the good times. It's about how much you don't lose when things get bad. And that's the difference between surviving and not surviving in most businesses, really. So let's look at this market today. These forward sales that you're seeing on the internet, like on Team and DLMS and such, these are amazing prices. I mean, we're just seeing absolutely phenomenal prices of calves and yearlings on the forward side. So you can lock in calves like $6 right now. When I do the math on the futures and options and LPI and all those things, they're down in the fives, below 550. And yet you can get $6 forward calf sales. So these feedlots are hungry. They're worried about supply, and they're already pricing in a very big premium just to get your calves and to get your yearlings. So, in my opinion, is let them have them. If they want these cattle for these prices, let them have them because they've already built in a huge premium for you. That's the best deal in town is forward sales, and I recommend it wholeheartedly. If you're worried, if you really do think this cattle market's going to go higher, and you think that we're going to have $7 or $8 calves, then just buy LPI. I mean, LPI is safe. It's at a good level right now. You're locking in somewhere around 5.5 for calves, and you can't buy calf insurance anymore, but you can buy feeder insurance to use on your calves or your grass yearlings. And there's pretty good levels you can lock in with LPI and still maintain your upside. But the best game in town, no doubt about it, is the forward sales right now. So let's look a little bit beyond the fall in case you're thinking about backgrounding and feeding. The feeding profitability is not looking good. When I look at the futures market, the forward pricing for the live cattle futures, which is your fed cattle, and then compare it to the feeder cattle pricing, that would be, what's the price of an 8 weight going to be looking forward using today's corn prices. The average return looking out the next year is about $300 a head loss. So either this futures market needs to go up or feeder prices need to come down. But right now, feedlots are projecting losses, and I don't even think this is factoring in $6 calves. I think this is using the futures projected price of $5 calves. So it's not looking good, but don't feel too sorry for the feedlots because they've had a really good turn. They just came off very high profits, $400 or $500 a head returns on this last cycle. So they're going to give it back here in the next one. And so this is a chart of live cattle futures, which represents fed cattle prices. And what I wanted to show you is where you see that star on the chart, that's where prices need to go for these feedlots to break even. So feedlots that are buying these cattle right now are banking or hoping that this market's going to just keep crawling higher. And that star would be a break even. The red on that chart is where I think this thing could go if it continues to stay very bullish. But you can see how the trend lines that I've drawn in green are getting steeper and steeper. And you can see from the last cycle, as those things get steeper and steeper, it kind of marks the end of a cycle. It means the thing's going parabolic and at some point it just breaks. But we're not there yet so far. The thing's just cranking up a little higher. We might see some higher prices yet, not sure, but we'll watch it. When you look at the futures market, the futures predicted prices going out for the next year and a half are predicting lower prices already. They've already priced in lower fed cattle prices for us. So we're sitting here just under $3 for our fed cattle today. By this time next year, they're already down at 280, 275. So there's about 7% drop priced into this fed cattle market by June of next year, and about a 15% drop by October of next year. So the futures market's already discounting this cattle cycle, saying that it's going to roll over. Whether they're right or not is up for judgment, but usually this is a collective bet of most of the players in the industry right now. So what about bred cow prices? What about calf prices? Well, there's a very, very high correlation between our upper end bred cows, which is our, that's your good 2 and 3 year old bred cows, and calf prices. So this year we've seen these good quality bred cow prices, like I'm talking the top of the top bred prices and commercial bred prices. They've been up around that $6,000 range for some of these good young bred cows. And that correlates with with the red line, which is the calf prices. Those calf prices are up around $6. So that's kind of where we are right now. You can see the bread prices maybe have kind of double top there. Maybe that's about as high as they're going to go. If we get a pullback, like I suggested earlier, maybe a 40% or 50% pullback in this thing, it'll take you down to where that yellow band is. And so that yellow band is indicating about $4,000 for an upper end bred cow and about $4 calf prices. And so I would think that would be a fairly standard correction. It depends on how quick it gets there, or whether it's over 5 years or whether it does it in a year and a half like last time. But I would think that would probably be a good target to look for in terms of long term. I don't think we're going to go below the highs of the 2015 cycle. So I think that yellow band is probably as far as this thing will go, but it'll just give you a target for yourself longer term if this thing turns to be looking at like say $4 calves and $4,000 for upper end bread prices. I was looking at the raising these heifers. I mean, this has been one of the best games in town, is turning heifer calves into bred cows or bred heifers. And it's actually getting tougher now because we're looking at right now, we could be looking at $3,000 heifer calves, replacement heifer calves this fall. And when you run the numbers on them, if they end up being $4,500, which is where they were last fall, it's pretty much a break even. So that shows you that they need to be significantly more than $4,500 to justify holding heifers versus just hanging on to more cows. The cows themselves, if as long as we have a flat market, these cows are just cranking out profits. You know, they're $700 to $1,000 depending on your costs. In this scenario, I've used $2,000 for the cost of raising a calf. That's kind of going on what I would say most people are actually at when you layer in all your costs and overheads and such. But there's pretty good returns holding these cows, and as long as the market stays in here. And there's not so much on raising heifers, which is interesting to me, which suggests maybe this market won't build like we think it will, and we might not see the herd rebuilding like we're hoping. If people see $3,000 heifers, they might just put them in the feedlot this fall. This is a similar chart to what I showed earlier with the calf prices, but now instead of calf prices, I'm looking at fed steer values. And this is the value of a finished animal. And you can see that it actually correlates to a bred cow price too, until recently. In the last year or two, the bred cows and the calves have shot off to, bred cows got up over $6,000. The fed cattle values didn't follow. They kind of lagged behind. And so if this bred cow thing is kind of topping out or getting a little hot, will it correct back to where the fed price value is? Well, guess what? That Fed price value is exactly where I said those prices would go in the last graph we were looking at, around $4,000 for an upper end bred, which would put you around $4 calf prices. So this is another sort of confirmation that that's a pretty likely target for this thing to head to. And this is the last color graph I'll show you on cattle prices, but this is the price of the calves overlaid over feeder prices and then the fed steer price. So the fed steer is in red, the feeders are in orange, and the blue is calf prices. And you can see every time you get these bull markets, those calf and feeder prices get way stretched higher. They're trying to incentivize growth, so they just push those calf prices higher. And what that does is it makes it really tough on feeding margins when those things get expensive. So the last cycle we had, what happened was the margins got so bad down the stream, like at the packer level, that we started seeing packers go broke and started seeing packers shut down in the US. And when that happened, then obviously there was less demand for fed cattle, and the fed cattle started to roll. And when the fed cattle rolled, then the feeder and the calves started to tip over on a lag. It was about a 5 or 6 month lag. So we knew the canary in the coal mine, excuse me, was those plants going dark. As soon as we started seeing plants disappear, then we knew the fed cattle were going to roll, and then the feeders and the calves rolled. We haven't seen that yet. So far, we're still trending higher on the prices. I think the fed cattle have probably seasonally topped out for now. I don't know if they're topped out, cyclically, but at least for the year they've topped out. And we haven't seen the plants start going dark yet. So there's still optimism for maybe higher prices yet, but you can see how stretched the margins are getting. You see how high these calf and feeder prices are getting relative to fed. So we'll just watch for a turn in this to know when our turn is coming. So what do we do if we know this cycle's coming where this thing could like top out or go down? How do we prepare ourselves? The most important thing I can suggest is take a look at these forward contracts. I mean, these are just amazing prices they're offering, and they're almost desperation prices, and that's okay to sell into that. You can live to, save some dry powder or whatever, but sell into that strength when you get those opportunities because they really are fantastic prices. There's the calf prices again, well above what you can hedge with other tools. So take advantage of those good levels. If you are doing forward contracting, I recommend you don't forward contract everything. You want to leave yourself room to sort these cattle, and that's for a number of reasons. Number one is that these cattle are so expensive that the slide on them is huge. So the difference in price between a 5 and a 6 weight calf would be your slide. And that number is huge now. It's almost a buck on some classes of cattle, and so you want to make sure that you're delivering to the right weight because if you deliver your cattle heavy and you got a big slide, it can knock $1 a pound off your prices. So definitely want to leave room to be able to pull the heavy ones off or pull the light ones off or whatever it takes so that you deliver at the right weight. The other reason you want to make sure that you leave room for a sort is that if you deliver at the wrong weight and this market tips over, that buyer can now look at you and say, well, you didn't deliver to spec. So, it gives them an excuse to pull out of the contract if this market decided to drop. So you want to make sure that if this market drops, you want to make sure you deliver at the right weight so that they don't have an excuse to pull out of the contract. And when you're looking at what weights should I be using for that forward contract? Well, you are your best judge. You know what your calves wean at. You know what your cattle come off grass at. So definitely use your own historical experience. Don't go on the livestock dealer's opinion. Don't go on the broker's opinion. Go on your past experience because you know that. And then if you can, try and get something on paper. Anything you can get, a signature, terms, whatever you can get, ideally would be best because if this market drops and drops fast, you're going to want to have something proving that there was a contract. Right now, if you don't plan on selling calves in the fall, it doesn't mean you can't forward contract. If you plan on backgrounding cattle, there's actually pretty good margins backgrounding right now that could be locked in with these forward contracts. So I was looking at it like if calves are 3,000 in the fall, and with some of these forward sales have been going, there's a couple of $100 a head in there. So you're pricing in fairly decent margins going right out to February and March. So it isn't just for fall calf sales that we look at these forward contracts. So lots of opportunity to do this forward selling right now, and I would really encourage you to take a look at it. Another tactic or idea when you get to the top of these cattle cycles is you're sitting on a tremendous amount of inventory value with these cows. I mean, you are sitting on a gold mine as far as these cattle, and it's time to ask yourself, do I need to own all or most of these cows, or what other strategies is there? So I'm not necessarily telling you to sell the cow herd and sit on your hands for 5 years, but there is the opportunity to maybe shrink down the herd. Like 5 or 10 years ago, you were lucky if you were making $100 a head on these cows. Well, now you're making $700 or $1,000 a head. So you actually, in reality, don't need to run as many as you were before and to make the same dollars. And we've just come through, several years of dry conditions where maybe it's time to reduce the cow herd, let the grass come back, take some money off the table, reduce your input costs because now you're stockpiling forages if you got less cattle. So feed less days, graze more stockpile, that type of thing. Just get some of that money off the table. Another way you can take money off the table is by taking in some custom cows or leasing cows, or finding ways for other people to own the inventory. You still run it because there's good margins in it right now, but let somebody else have own those cattle for at least a portion of your herd. When a market drops, you can't really hedge the bread price very well. It's really difficult to hedge that bread price. So, if you got like a $7,000 cow and you get a market turn, she might be $4,000 and you might lose $3,000 a head in depreciation. But with yearlings, you can actually lock in those values pretty tight with livestock price insurance or some of these other tools like futures and options. So you might consider swapping out a portion of your cow herd into a yearling program and doing high intensity forage programs and those type of things. But you can hedge yearlings. You can lock those values in where it's more difficult with a bred cow. So just some thoughts. And you might consider phoning your Uncle Bob from the city, see if he wants to own a percentage of your cow herd or something. There's ways to maybe sell a partial interest in your cow herd. You still run them, but let other outside investors own a share of them. Just a way to get some of your dollars extracted out of the cows, and then take that money and reinvest it in infrastructure, reinvest it in forages, reinvest it in getting yourself ready for when this market pulls back so that you got dry powder to hit the thing again. You might play the depreciation game. Some cattle are going to depreciate more than others. And I won't go into this in detail, but it's like, that when this market turns, a lot of those $7,000 cows, if they turn into $4,000 cows, like I said, there's going to be a huge hit. But there's some of these cows that if they're priced fairly, really aren't going to cost you much. They're not going to drop that much. Some of these older cows and things like that, their values probably won't drop near that much. So there's a depreciation game that can be played there. And the most important one, and maybe most applicable to you tonight as a forage association and forage association members, is finding ways to do this year-round grazing stuff and get your costs down. Because if I said, I said earlier that let's say it costs $2,000 to raise a calf nowadays. Well, if you can cut that down to $1,000, your margins are going to be so wide that it doesn't matter what happens to your bred cow inventory value. As long as your margins are that wide and you spread that out over 8 years life of a cow, you're going to be doing really well. So one of the best hedges I've always said was cheap feed. And so if you can find ways to get these cattle to feed themselves without mechanical feeding and such, that's one of the best hedges that you have. Just a few points on leasing cows, because I don't know how many people are familiar with it, but let's say you were trying to sell your cow herd today and you just ran it into the auction mart. Well, you're going to get a big check, but you're also going to get a huge tax bill. And so if you wanted to avoid some of that tax, you can kind of spread that tax bill out over several years just by leasing the cows out. And by leasing the cows out, it basically means you're giving this cow herd to somebody else to manage. They're paying you, say, 10% lease fee on those cows. So you're making a return on those cows. You're getting them locked in at today's values, and you're spreading that income out over the next several years. So it's actually a tax advantageous way to get out of your cow herd. But it's also good for the operator because if you can pay $700 or $1,000 or whatever that lease fee is and get a $3,000 calf out of that cow, that's a pretty good return for the operator too. And now you don't have to go out and borrow all this money to buy $5,000 or $7,000 cows. Now you're borrowing enough money to pay a lease fee of $700 to get $3,000 calves out of them. So it's something to explore and think about, just ideas. Obviously, in a high market like this, your one of your biggest tactics too is hedging. And this is something that I obviously talk about in a lot of my talks. But if you look at the cumulative gains and losses and prices over the last 20 years, that's that blue line. Some years you gain and some years you lose, but you add all those wins and losses up over the 20 years and it's kind of a flat return. Whereas hedging is just making sure you don't lose money on those bad years. So instead of losing 10 or 15 or even 20% on those sort of big drop years, if you only lose, let's say, 2% or 5% or at most 10%, that's the difference between that orange line and that blue line, where that market just kind of fell apart for 5 years between 2015 and 2020. By having yourself hedged and having those losses limited, that would be the difference between that orange and that blue line. So the returns are much higher if you're doing this every year. All you have to just bank on having 2% of your CAF income invested in hedges every year to avoid those kind of big drawdowns like that. When you're hedging, it's not like if you know there's a 5 year downturn coming towards you, the obvious way to get the value out of your cows is to sell. I mean, that's the easy way, but it's not the best way because then you have to figure out what to do for the next 5 years. So when you're hedging, you really can only hedge 1 year at a time, and you're going to have to kind of stair step it down. It's really hard to lock in a price for a 5 year period with hedging. All you can do is kind of lock them in 1 year at a time. So for example, I showed this chart earlier, like the futures projected price of a finished animal is looking to be down maybe 7 to 10% in this year. So you can't lock in a profit right now, a year out. But if you're locking in a 7% and that's the worst you do over the next year, that's not bad. You'll survive that. It's only going to cost you maybe 2% of the value of your animals to make that hedge, and you're locked in at a 7% loss. If the market really took a nasty turn and went down 15 or 20%, that 7% guaranteed minimum loss or maximum loss will look pretty good to you. So don't worry about the fact that you can't always lock in profits. It's more about kind of that Warren Buffett thing. It's about locking in, making sure that your losses are restricted. People often ask, how do you hedge a bred cow? Like, I don't want to sell my bred cows. I like my cow herd. I don't want to get rid of them. I don't care what the cycle says. I want to hang on to these things. Well, okay, well, how do you protect your bred cow values? And the best way I can show it is that chart I showed earlier, how that correlation is so high with calf prices. The way to hedge bred cow prices, if you really want to do it, is doubling and tripling up your calf hedges. Now you can't do that with LPI because you can only hedge your calves on it with livestock price insurance, and obviously can't do it with a forward sale. The only way you can double and triple up your calf hedges is with futures and options. And so it'd be basically whatever your calf inventory is, you would hedge like 2 or 3 times that value to try and protect your bred cow value. Only way I know to really hedge that, other than selling cattle or taking money off the table. And the last sort of tactic I'll show you is seasonality, and that's just the idea that there's always a cycle within a cycle, no matter whether it's a bull market or a bear market or a sideways market. There's always that seasonality. We always know calves are born in the spring and sold in the fall, and all those calves become 8 weights by March and April. So there's lots of them at that time of year. Usually a buying opportunity. August, September, the cattle are out on grass. Feedlots can't find them. Prices usually peak for feeders that time of year. That works, most years. When you these are the last 6 years. If you just bought in March and sold in September, you can see by the stars that it worked 6 years out of six of the last. So it's those kind of seasonal patterns and trends are pretty reliable, and you can build your hedge plans around them as well. In the last top of the market in 2015, that seasonal pattern was still in play until it broke in September. So you would have had to get your cattle priced before that thing broke in September. But even in 2016, when that market was just absolutely falling out of bed, there was still that seasonal pattern in there. You could have bought in March and sold maybe in August, maybe not September, but you could have sold in August and still made money from a price perspective, even in a rapidly falling market. So those seasonal patterns you want to pay attention to. And every weight class has a different seasonality. Generally, I would say if you think you're in a falling market, hedge early. Don't try and get fancy and wait for the seasonal patterns. you probably just want to put your hedges on early for the start of the year and ride it out. So I'll kind of close out. I got four scenarios that we could look at. Nobody knows what this market's going to do, including myself. So all we can do is kind of look at targets. And I'll give you four different scenarios that you can look at. One is the bull case scenario. That's the fact that we've gone on this steep trajectory and that we're just going to keep riding up there. I've measured that out with that pink band on there. Um, and I've equated that now into what that would be for Canadian calf prices. And so that's if this thing keeps going up to where I'm saying that target is, we could see $78, $7 to $8 calves. It's very feasible if this market continues. That's the extreme bull case. A more sort of conservative case is that this thing's topping out now. I have many reasons and cases I won't go into right now to suggest that this is possible, that this thing is getting a little toppy here. If it does, it might do a modest, what they call 38% retracement, which is, if you're a technical trader, it's just a modest pullback within a bull market. And that could take us down as low as $4 by, possibly by the end of the year type thing, would be just a standard pullback correction within a bull market. We've had a pretty good run, and seasonally, this is the point of the time of the year when things start to fade or start to roll, especially on the live cattle side. So there's a potential that we could see $4 calves, by early next year type thing, and then the market takes off again and goes for another rip. That's scenario number two. Scenario number three is that the cycle's done. This is the 2015, 2016 type scenario where the market goes up for 5 years and then it just gives it all back. I don't think that's the case this year, but it's something you want to be prepared for in the worst case scenario with your hedges. And I would suggest that the target you're looking for on the bottom end is $3 calves. Let's hope not. And then scenario four, I think, is probably the more likely scenario where at some point this thing will top out. I don't know if we're there yet, whether this thing's going to keep running a little bit more, but at some point it'll top out and then probably give back, 40 to 50%, somewhere in that range. And then it'll just ping pong between, 350 and $5 to $6 calves. And so you're really going to want to hedge in that environment because it's going to be a sideways market. And I believe it'll be a sideways market for a long time before this thing kind of catches its breath and goes for another. So this is really the hedgers game because you're going to want to be hedging every single year. When those calves get to $5 or $6, you want to lock them in and try and buy your calves down around that 350 level. So just a sort of a sideways, and I think this is probably the most likely scenario myself. And just as a final slide, just to remind everyone that these cattle that we're running are preserving and cash flowing at least 10 acres of grasslands or more. And these grasslands are where nature lives. That's where all the animals are, where all the birds are, the wetlands, the trees. We are preserving nature and cash flowing it with these cows. And I think we need to just remind our society and our politicians and everybody that the value of these cows and how important they are in terms of preserving the nature that everybody wants to preserve. And so if you want to know how healthy nature is doing, count the cows. And when I see the cow herd down 35% in the last 20 years, it says to me that's what's happening with nature as well. We need to make sure that we're not too innovative, that we're getting rid of the cow herd to a level that's going to be detrimental to nature. So I encourage you to keep building the herd, even though the cycles may turn every once in a while. Keep rebuilding cows, keep growing, and hopefully we'll keep this nature intact. So thank you very much. This is my website is cowsandcontrol.com. If you go there, I've got a free newsletter, no obligations, just a free monthly newsletter. I also have client services available through my program there. And then I also have a website for people if they want to try and forward sell bred cattle. It's a new service and I'm trying to get off the ground here. So I'd be glad to take some questions and thank you for your attention.
Excellent. Thanks, Ryan. That was very informative. Really appreciate your insights and sharing the strategies with us. You guys have Ryan's information right in front of you. So if you do have questions with him, please do feel free to reach out and ask him directly. Or if you want, we can even help get you guys in contact with Ryan as well.
Oh, thank
If you
you.
guys want more information on Foothills, you can find us at foothillsforage.com and